Let me walk you through what's going on right now. The 50-year mortgage thing popped up again today. Moody's, big credit rating outfit, comes out waving the red flag, saying it's going to jack up default risk and bury people in interest. And yeah, headlines ran with it like we're about to sign our lives away. That is pretty standard stuff. Here's what stands out the most. The monthly payment barely moves with the 50-year mortgage. But the lifetime interest number, that's the one they shout from the rooftops. They're talking about it like they're actually going to sit there and make payments for 50 straight years. I mean, dude, most people don't hold a 30-year note for more than a handful of years. The easiest way to picture this is, look, imagine renting your neighbor's old Schwinn. Sure, it's a little cheaper each month, but you're paying for the same bike forever. That's how the media is framing this. Like you're stuck riding that until your knee gives out. Nobody stops to mention that you're going to be switching bikes long before that. And here's what shifts because of it. Most people qualify on paper. That alone is going to bump up demand. And in a tight market, that means prices are going to creep up even more. Equity is going to build slower early on, but honestly, that's how it works no matter what loan term you pick. Here's why this needs to hit home for people. Everyone already feels stretched. Salaries aren't keeping pace. First-time buyers are basically middle-aged now. So when someone says 50-year mortgage, yeah, people assume it's a life sentence. That's where the panic is going to come from. And here's the part most people never hear about. Banks love long loans because they get paid longer. Politicians like it because it dodges the real issue, building more homes. And lenders might bump rates a hair just to cover the risk. That's the game. Stretch the debt, don't fix the shortage. So here's how different experts see it. Some are saying that savings are too tiny to matter. Some say, it's fine. It's just another option. Others worry about slower equity and long-term risk. And the contrarians say it's basically a dressed up IOU to the bank. Everyone's arguing over the same surface level math. But here's the angle nobody is tracking yet. A 30-year loan and a 50-year loan look almost identical for the first 10 or 15 years. That's just how the amortization works. The only real difference is way down the road, long after most people have moved or refinanced. In markets with high prices, that's where the product will land first. And yes, there are two totally valid interpretations here. One side says it opens up the door for people who couldn't buy before. That's true. The other says it traps buyers in a deeper debt with almost no relief. If you zoom out, the big players are thinking this way. Debt gets weaker over time in an inflationary system, and that is by design. So paying it back later with softer dollars, it's not always a punishment. It's called leverage. That's the part nobody on TV is bringing up. Now, has anything like this ever happened before? Yeah, it has. Every time affordability tanks, lenders get creative. Adjustable rates, interest only, stretched amortizations, all those phases push prices up, and it slowed equity, and eventually it fractured a couple markets. There's a lesson from all of that. Extending time doesn't fix the shortage. It just buys you a little breathing room. So here's the quick version for the people who actually think about their money. In the early years of a mortgage, you're barely touching principal anyway, no matter what loan you picked. So losing a little early amortization doesn't mean you walk away from the appreciation, cash flow, tax benefits, and leverage. Thinking that all debt is bad, or I never touch a 50-year loan, I'll pay 3 times more for the house, is deranged thinking once you actually look at the math. It just means you're paying interest longer in a system designed to weaken the dollar over time. That's not always a bad trade, especially when that debt helps you control a real asset in an underbuilt country with somebody else making the payment. And that's exactly why I pulled this next video out for you, the one back here. It breaks down how high-income professionals consistently engineer 30+% returns without ever having to flip a house, without having to be a landlord, and without ever giving up their upside to funds or syndicates. That's the video right here when you're ready.